What's going on, guys? My name is Alex, and this is the first time I ever do a voiceover or just talk in general, so just bear with me. But I just wanted to do a breakdown of the trade I took using the New York launch macro. So as you can see right now, I'm placing the sell limit at the low of the breaker. Obviously I don't have to explain what a breaker is: high, low, high, high. So we'll just be watching how we react off that mean threshold of the breaker and see if we either displace above it or we use it as resistance. But let's get to the point of this video, which is the launch macro. So I'm just going to try to do this in one take without cutting or anything. I don't have a script, so just keep that in mind. But what a launch macro is, it works like any other macro. Is basically a list of directives or instructions for the algorithm that tell it to do this specific thing at this specific time. The only way in which the launch macro differs from a normal macro is that in its delivery is basically set. It's instructed to do a very specific thing, and that is take out trailed liquidity that's been trailing up with the market. So the key times that you want to pay attention to is essentially 10:30 a.m. and this is all New York time, by the way. So if your trading view chart is not set to New York time, you should probably do that, because basically the whole algorithm runs on New York time. But yeah, you want to look at 10:30 and 11:30 usually, and I'm speaking for NQ and just the futures markets in general. I don't have much experience using this launch macro in Forex, but it does work. I've used it before, but I just haven't used it enough to really, say that I'm confident in this happening every single day. But for the futures markets at least, usually between 10:30 and 11:30 the market will be trending. So as ICT said, and by the way, all of this information comes from ICT, so big credits to him. But following that 9:30 a.m. open, the high or low of the day will essentially form inside that opening range or just shortly after. So what you can expect on a good day is that the market will usually reverse around 10 a.m. in the morning, and it will keep going in that same direction until around 11:30 when the launch macro starts. So if you could just imagine a displacement leg higher following that 10 a.m. hour, if you look closer, obviously it's going to have short-term lows inside of it, and those very lows are going to be the target for the launch macro, and that's the target for this trade you're seeing right now. So where I put the TP for this trade, that's where we have equal lows in the market, and that's going to act like a magnet for the algorithm, and we're just waiting for it to tap the breaker block. But yeah, we're going to be targeting just lows formed between 10:30 and 11:30 as people who, again, bought when the market reversed. They will be trailing the stops higher with the market, so the market maker's gonna want to target those people, and it does so through the launch macro. So just a little bit more on the macro itself. Obviously it's meant to start at 11:30, but on some days you'll see that the 11 a.m. macro also has an impact on this one, because if, say, we took liquidity, so in this example, say that we took buy side liquidity at 11, it will start reversing and start targeting that sell side, those trailed stops, before 11:30 essentially. So that's one thing you have to look out for. And the second thing you want to watch out for is that trending market. So the market must be trending between 10:30 and 11:30. If you don't see that, or if the market just goes into a tight range between 10:30 and 11:30 and just creates an ugly consolidation, then the chances of this launch macro working as it's intended to will be less likely. So I would consider not using the macro when you see days like that. But yeah, with that said, I'm going to speed up this video, and whenever something important happens, I'll come back and just resume it. Okay, so as you just seen, we got tapped into the trade there inside of that breaker, and I really like the fact that we didn't close above that mean threshold of the breaker. That's a very good sign. And the fact that we displaced lower from it only adds to the confluence to this trade. You're going to see in a moment I place a partial at, well, not place, but I'll take a partial at that low, or just slightly before it. I do that just to secure some profit in case this trade runs against me. So as you can see, the partial has been taken just before that low, and I think I'm getting ready to take another partial when it actually takes the low, because right now we just formed equal lows. So it's always good to take partials when we take lows or equal lows. So right now we're retracing back into that BISC, which is a buy side imbalance, sell side inefficiency. I would like the market to stay in the lower half, which is what we see here, which is a very good sign, by the way. It means that we are respecting the PDAs and that we're in a sell program now. We should see displacement following this if we don't trade any higher, so we shouldn't touch that 50% of the fair value gap, and then we should displace through the low that we just created, and that's where I'm going to take another partial. So the thing that I just put on right now is just the quadrant levels for the wick that we have formed earlier. When you see large wicks like this in the market, just treat them as fair value gaps, as ICT says. So basically we have the quadrant levels, the 0.25, 0.5 and 0.75 levels. Ideally we would want the market to stay in that lower half of that premium wick. So we wouldn't want the market to close above the 50% level of that wick. And I think that's what we see in a bit here. We'll trade to the lower quarter of that premium wick, and then we'll displace lower. And there we go, that's our target hit now. Up until now I took 3 partials, that means we have 1 contract remaining. Each partial I took off 1 contract, and we sold originally 4 contracts, so we have 1 contract remaining. And as you can see earlier, or as you can see now rather, I'm about to move the take profit a bit lower to today's first presented fair value gap after 9:30, because usually the market will return to that fair value gap. So as you can see right now, I'm changing the TP. I just have 1 contract left, which I'm leaving as a runner. So basically the trade is over, and this is just like a bonus. So here you can see that I typed out that I'm getting bored of holding this trade. 1, that's because I had to go do something, so I couldn't stare at the charts for much longer. And 2, if we were going to trade to that first presented fair value gap, we would do it quickly. There would not be these small retracements up. It would just be straight displacement down. into that fair value gap, which is obviously something that we didn't see. So that's the reason why I typed that out. I move the stop loss to in profit just above that, or slightly below that short-term high that we formed. We wouldn't want to see the market close above this CB. If it does so, then that could mean the market has reversed and it will begin trading higher. So the last contract has now been closed, and I'm about to type out the reason why. But it's practically because we're spending too much time within that small range that we created, which is not a good sign, because in the eyes of retail, we are forming a bearish flag, which would indicate that price is going to go lower. But that never works. So price is actually going to go in the opposite direction, and it actually does if you go and check the market and see what happens next. So that's the reason I took off the last contract there, spending too much time. And if we were to go lower, we would do it. There wouldn't be any of this back and forth price action. But yeah, that was the launch macro. I hope you guys learned something. I hope you find this video useful. If you guys like this voiceover type thing, just let me know down below, and I'll do more of it. But yeah, until next time, take care, guys.